Do you want to earn while everyone else loses? If yes, you're at the right place. Talks about a looming recession have been circulating headlines for months, with no clear answer as to what Americans can expect. While some economists don't see a global recession happening anytime soon, other top finance execs have predicted everything from a recession by the end of this year to a 50-50 chance of a recession next year to a mild recession come 2024. JPMorgan Chase CEO Jamie Dimon sparked a cause for alarm last week when he warned of an economic hurricane. One thing we know for certain is that today's record-high inflationary environment, and in turn, the Federal Reserve's swift tightening, is a key factor contributing to a potential economic downturn. Historically, recessions have typically followed the Fed raising interest rates to combat high inflation, though there are a number of other recession indicators to consider in the bigger picture, such as rising unemployment. It's no doubt that recession fears are leaving many Americans feeling uncertain about their financial futures. In fact, a recent CNBC All-America Workforce survey found that 83% of employed adults are worried about a recession, making it the biggest near-term concern and beating out worry over wages, 74%, COVID, 62%, pay cuts, 46%, and layoffs, 44%. Since a recession is technically defined as 2 consecutive quarters of declining gross domestic product, or GDP, we won't know for sure until the numbers are reported in July. Keep in mind, however, economic flows such as this are inevitable, though there are some investment strategies that can take advantage of recessionary forces to position a portfolio for a quick and strong rebound, which is what our video is about today. Hello everyone and welcome back to Sticking Point. Before we tell you what investment strategies you need to follow to not only protect yourself, but also win in the expected recession in the coming months, make sure to subscribe to the channel for more similar content. Let's dive in. 1. Use the dollar cost average when share prices decline. As with most recessions, you probably will not see the next one coming, but you will likely see a sell-off in the stock market well in advance of a recession. When that happens, remember the first lesson: there is recovery after a recession. Knowing that, investors can take advantage of a declining market through the dollar cost averaging method of investing. If you make monthly contributions to a qualified retirement plan, you are already using the technique. But when the market starts to plunge, it is in time to take advantage by increasing your contributions or starting dollar cost averaging in a non-qualified investment account. When you dollar cost average your investing, you are gradually reducing your overall cost basis in the share price. So when the price rebounds, your cost basis is always lower than the price. For example, if you invest $500 a month in a mutual fund selling for $25, your contribution buys 20 shares. If the share price drops to $20, your contribution buys 25 shares. Your account now has 45 shares with an average cost basis of $22. As the share price drops, your $500 contribution buys an increasing number of shares, and your cost basis continues to drop. When the share prices rebound, your contribution buys fewer shares each month, but the current share price is always higher than your cost basis. The dollar cost averaging method works best over the long term for investors who do not want to worry about how their investments are performing. 2. Buy into dividends. If you are going to hold stocks during a recessionary period, the best ones to own are from established large-cap companies with strong balance sheets and cash flows. Not only are these companies better situated to weather economic downturns than smaller companies with poor cash flows, but they are also more likely to pay dividends. For investors, dividends serve a few purposes. First, if a company has a long history of paying and increasing dividends, you can have peace of mind that it is financially sound and can survive most economic environments. Second, dividends provide a return cushion. Even as share prices decline, you still receive a return on your investment. It is for these reasons that dividend stocks tend to outperform non-dividend stocks during market downturns. The best way to own dividend stocks is through mutual funds or exchange-traded funds, ETFs, that invest strictly in dividend-paying companies. Funds that invest in companies with long histories of paying dividends and strong track records of increasing those dividends tend to generate high current yields with capital appreciation. However, don't expect these funds to outperform the market during market rebounds. They are held in portfolios to provide stable returns across different market cycles. As the market rebounds, you can gradually allocate away from your dividend funds, but you should always maintain a portion as a defensive measure. 3. Invest in consumer staples. Even during a recession, consumers need to buy food, drugs, hygiene products, and medical supplies. These are consumer staples that are the last items to be cut from the family budget. So while companies selling flat-screen TVs and other discretionary products experience price drops in revenue, companies selling food products and other basic necessities do not. Because of this, consumer staple companies are sometimes called defensive stocks, since they tend to remain resilient even when the economy falters. Data shows that these types of companies outperformed the S&P 500 during the last 5 recessionary periods. Consumer staple companies include Johnson & Johnson, Procter & Gamble, Conagra, and Walmart. These particular companies also pay good dividends, which is also strengthening their defensive profile. They are also mutual funds that invest strictly in consumer staple companies. The Fidelity Select Customer Staples portfolio invests a minimum of 80% of its assets in companies engaged in the manufacture, sale, or distribution of consumer staples. Should you switch to a recession-proof career? One of the worst aspects of a recession is seeing hard-working folks lose good jobs through no fault of their own. While this article is designed to help you find industries worth investing in, it's also important to consider the effects of a recession on your employment prospects. A recent study conducted by Insight Global found that 78% of workers were worried about losing their jobs due to the possibility of a recession. Hopefully, these fears of job loss don't turn into a reality, but it's important to be prepared. If you've been thinking of making a career change, this could be the sign that you finally need to take action. Should you only invest in recession-proof industries? During a recession, it's no secret that stocks take a tumble as investors panic and the markets are filled with volatility. Does this mean that you should invest in companies that are believed to be recession-proof, or should you continue putting your money into companies that you believe in? While we took the time to highlight recession-proof industries in this article, we can't deny that they won't always guarantee success, as there's no telling how the stock market will react to the recession overall. The truth is that you can never be fully insulated from the effects of a recession. During a stock market sell-off, even the best-performing companies are impacted by investor panic. All you can do is focus on investing in companies with strong financial fundamentals while keeping your eye on the long term. We should expect plenty of market volatility during a recession because investors may want to liquidate their assets. Investing in the stock market will always come with some level of risk. There are no guarantees when attempting to make return on the money. The goal is to become knowledgeable about different market conditions, to identify recession-proof industries, and continue to invest in companies you believe in. That was all from us today, folks. Stay safe in the upcoming recession, and we hope to see you back on our channel in the next video.